Welcome to No Fluff, Just Ideas. This is your host, Sophocles, and we're going to be discussing investment ideas from around the world. So buckle up and enjoy. This podcast is for educational purposes only. Full disclaimer at the end of the podcast. So I'd like to welcome today Jeff Gilbert. Jeff is a forensic accountant and CPA, and we've chatted a few times about some fantastic companies. And I know he recently was considering pitching this company in clusters, but didn't make it. So I reached out to him and he was nice enough to say, sure, we'll do a podcast about it. So welcome, Jeff.
Thank you so much, Sophocles. Happy to be here.
So what do you have for us today? What has tickled you?
The idea is called Howden's Joinery. Howden's Joinery is out of the United Kingdom. They're an interesting company. So the first thing to know about them is their mission statement: we make the builder's life simpler. As far as I could tell, capital allocation has all been true to that strategy, with the occasional dividend and share buyback, so shareholder friendly too, but they work to make a tradesperson's life simpler. How they do this is they have 869 depots in the United Kingdom, which means that 85% of the UK is within like 5 miles of a Howden's Joinery depot. 90% of their business is residential. They've been in business since 1995. When you conceptualize what this depot looks like, think of it like a Home Depot, only way flipping smaller. So they're like 10,000 square feet. They are not a huge, massive warehouse. The life of a tradesperson is not fun, in my opinion. So, okay.
Tradesperson. What's a tradesperson? Just for people who might not know.
So picture a carpenter, a general contractor, somebody who would come in and do a large renovation. They tear out a kitchen and build you a new kitchen. They need to meet with you. They need to figure out where to get the kitchen supplies, materials from. They need to coordinate with an electrician. They need to coordinate with the plumber. They need to coordinate flooring. There's a ton of design choices. Customers who want things cheap and they want things quickly and they don't want their house destroyed for a long period of time. There's customers who don't want to pay till the product is absolutely done. And so their life is challenging. And Howden's is like, how do we help tradespeople to make their life, let's call it, simpler? And they, in my opinion, did a brilliant job at this. So just by way of an example, you don't pay Howden's if you're a tradesperson. You're a carpenter, and they don't sell directly to customers. They only sell to tradespeople. You don't pay for 60 days. So that's after the customer's already paid, after you've already collected your receivable, then you owe for your materials to Howden's. And by offering 60-day free credit, no interest, this is a trade-friendly way of doing business. Design is horrible. Like if you're a carpenter, you're not necessarily an amazing interior designer. Great. Howden's will meet with the customer. They'll do custom design choices. They have designers up the yin yang. They can meet virtually. You name it, they could do it for you. The one more caveat within this stuff. When I studied Home Depot, it was super interesting. Home Depot is like a professional division. So does Lowe's, so does Rona's, any of these big players. 10% of their business comes from like professional carpenters, general contractor business. Like 10% of Home Depot sales. 10% of their business is from like a carpenter. 50% of their sales, though, is from that 10%. So, in other words, tradespeople make up a disproportionate percentage of total revenue for Home Depot. Only 10% of the customer, but they represent 50% of the sales. Howden's is onto something when they're like, we are going to solve the tradespeople who are the real purchasers, and they're the key decision maker. So just to delve into another level of detail here.
And on that, because I was reading into some history of Howden, I think they used to have stores, I think about almost 20 years ago, around the financial crisis, and they sort of like got out of the stores.
Right. So there was a group called the MFI Furniture Group. There was bad losses. There was a pension liability that was massive. There was private equity involved. You name it, it was a mess. There was a guy by the name of Matthew Ingle. Matthew Ingle's the founder of Howden's Joinery. And he worked, it's a super interesting story. He worked in lumber. He worked for Magnet. He worked for MFI and in progressive roles and progressive responsibilities. And he saw that there was a need to split off retail and trade. And that was his key decision. So he founded Howden's, and that decision to go into trade only, in my opinion, saved the entire business. This would have failed if it tried to do both. So he took on some progressive responsibility, including being CEO of basically a failing company, and he managed to push through. And that involved selling some unrelated businesses and getting some cash in. And it also involved not failing on the pension side, which I thought was very, very cool of him. Like he had outs if he wanted to, and chose the harder route.
So he was part of MFI, is that right? So he was an employee of MFI, and then basically became CEO of what's now Howden. Is that how it is? Or
correct?
Did he have put in his money of his own, or was he just he just got his shares working as CEO?
He had some money going as it was, and so took that, rolled it in, and created, and this comes, by the way, he wrote a book. It's called Kitchens or Sink. And so like it goes in, it's a deep, deep dive into his life. Sophocles, I don't know if you're like me and you study a bunch of biographies, but that's how I actually found this business. I love reading biographies as a way of understanding business because they intertwine their life, they intertwine what they experience. He talks a lot about wood, different lumber, all right? And by the way, he was a horrible, horrible student. And so he literally failed. He was the worst in his class in England every single year. He also was diagnosed with dyslexia, which might be part of the root cause. That cause, if you study enough biographies, you find some themes. People who think differently sometimes have dyslexia. And there's a lot of very, very successful individuals like Steve Jobs and Einstein who have dyslexia. And they overcome extreme obstacles. And he overcame a lot of extreme obstacles, including finding Howden's. Yeah, so, okay. The brand was developed by Matthew Engel. It's a business unit within MFI. And that's would have been around 95-ish. It started with 14 depots, now up to 860, whatever. In 2006, MFI sold its retail business to a private equity for like $1. He helped save the pension liability. MFI was changed to Galliform is the name of that entity. But the real key here is in 2007, Howden's was formed by him. 2008, MFI went into administration and failed.
So I found actually the book you're referring to, it's actually on Amazon, Kitchens or Sink, How to Build a FTSE 250 Company from Nothing. Oh, there we go. When he was made redundant in 1994, he had an idea for a business jotted down on a single sheet of paper, but no name, no products, no buildings, and no backers. Howden's was founded in 1995. Today is a FTSE 100 company, blah, 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 blah. This is the story how he got there. Okay. That sounds like I'm going to have to put that on my reading list. I actually found Howden I was looking at the holdings of a successful a mid-cap fund that's in France. And so I was looking through that, and that's how I stumbled upon Howden's, and I started looking a little bit at it, and I was like, oh, this is really cool. So he was there from the beginning. Does he still have some shareholding in this?
I believe he does. If you look up on like Bloomberg or whatever, the holders, it's like 2% in this. BlackRock owns a bit, 1 or 2%. I don't think he sold out of the stock. So I think he still owns a fair chunk of this company. Yeah.
Okay. So the thing with Howden, and where are they positioning themselves? Are they considered low end, high end?
Fair enough. To me, they're low to mid end. They have three. It's super simple. Everything they do is like very transparent. Like their annual report is easy to read. They're like, listen, we have good, better, best. That's our three families. Got it. Like they do. Like good is obviously equivalent of cheaper. But even their best, when I looked up what's the average price of a best Howden's kitchen, let's call it 10,000 pounds. This is not luxury. It's not premium. Yep. They're not using ebony, right? Like hardwoods from South America. Their design doesn't come out of Italy, right? Like if you're a high-end, you own a castle from the 1800s, your odds are not using them.
Yeah.
Low to mid end. They do say that their higher end division they've been focusing their efforts on. Howden's, once again, to their credit, did some very cool stuff. So you can now do custom paint. You can now do custom countertops. By the way, they do vertical integration. So they don't just manufacture it, they also bought a countertop company. They do paint to order, so you could get a wide range of colors. So they see that there's higher margin in the higher end, so they're pushing that. Be that as it may, I wouldn't describe them classically as high end. I would low to mid is where I would put them.
I'd like to add, I have looked at their annual reports. They have some nice, cute cartoons in them, and you can see some consistency there. Looking back at a few of them, I haven't done a deep dive, but I was just looking back at a few of these annual reports, and there's one characteristic I noticed of high quality companies is that there's a consistency within the accounts. I don't know, you're a forensic accountant, maybe you can tell me, but you can see consistency of they report this every year,
Right.
and they're not messing around showing things in different ways to make them look better. And there's a nice little section where they have this like Q&A going on the company, and so you can better understand. Now, the thing is, there is a difference, about how the market works in the UK versus Europe. Apparently, there's, these buyer groups, which is more common in Europe and less so in the UK. Within the UK now, there is this entry of these buyer groups. How are you thinking about this? Or let us better understand what's going on and if there's a threat here to
Yeah.
the model.
So, okay, let's go back for a moment here. You have the depots. They're populated throughout all of the United Kingdom. Great. They also manufacture their stuff. So the countertops, the cabinets, they call it the carcass, like the actual item that you're buying, right? Like that makes the cabinet. This is all manufactured from them. So they guarantee that they're going to have this stuff in stock at local depots. They further say, hey, tradespeople, if you want to do a custom order, so you want a custom paint job and you want us to do a countertop for you, we guarantee our production schedule, and they fully control it. They control the manufacturing, they control the shipping of it, logistics and the movement of it. So they are a logistics and efficiency company with a very high, just in time. They have the inventory, it's in stock, waiting. So it's very, very convenient for the tradesperson, i.e. load up your van, grab the kitchen, and off you go and sell it to Mrs. Jones. They say to the tradespeople, the more you buy for us, the cheaper it's going to be. We're going to give you a huge discount. So it's very, very sticky. Once they get a tradesperson and they start using them, okay, it's very easy. It's close to Mrs. Jones's house. I just pull up in my van and I get a huge discount. They never share their prices. They're not like a retail shop. They're not IKEA, where it's very open about how much things cost. Instead, it's all confidential. The customer would never know. So they could say to their general contractor, hey, how much is this going to cost you? It's up to the general contractor to be transparent or not with that pricing. In other words, they can mark it up or not. They could take the spread from their discount and keep that or not, or pass it on to their customer. It's at their discretion. You think about how many problems I just described, from getting the stuff, production schedule, the 60 days free credit. They've solved a lot of problems, and they're entrenched now in the UK. So they became the biggest kitchen manufacturer. Europe, the rest of Europe, not so much. When you study their international expansions efforts, they launched in Germany and it didn't work. They launched in France, a whole bunch of locations, those failed, and they took some of them back. And they came up with a different approach, a different strategy called their city center approach, which is they want to start right beside a major urban center, and they want to go dense and get enshrined within that small community, within that city. For years, and I'm talking for over a decade, they compounded beautifully in the United Kingdom. Word got out, tradespeople wanted to use Howden's. Howden's was part of the network. People talked about it, and it compounded and it grew to the point that they could open a new location, payback period within 2 years. International, man, is it more challenging for them. They're not as known. When I did the sales per international depot versus UK, it's not at all like triple, easily triple. UK is better. They say this publicly. They're like, we need 7 years to become a mature, established with our networks, become sticky with the tradespeople, etc. When I studied the German failure, there was a company there, the name is escaping me, but they had been around since 1946. High quality. They're one of the largest kitchen manufacturers in Europe. They already were established. They already had the quality and production means, and they were already Howdens. In other words, that's what they're walking into, a highly competitive, long established. It's not like there wasn't a need for kitchens in Germany for multiple decades. And so that's not the easiest thing to break into. So for future forecasting purposes, I'm not like ridiculously over the moon optimistic on future international expansion. I think it's a challenge. To the credit of this company, it's one of the things I look for. If you study Jeff Bezos, he said, my default answer to everything is yes. If you want to say no at Amazon, you have to write a long position paper as to why you're saying no to an idea. This is how Amazon Web Services came to be. Howden's a little like this. They're willing to run tests and they're willing to run experiments. This is how they ended up in bedrooms, in flooring, in countertops, in custom paint. Notice everything here is not something crazy. Like Sophocles, as an aside, I own a stock. I don't want to say them publicly what they did, but anyways, they're in business X and they go ahead and they use their excess capital for a completely unrelated business. They all of a sudden are getting into computers and it's nothing to do with computers. And I'm like shaking with anger. What are you doing? Like, these guys with their capital allocations are running tests. It doesn't bother me that they tried to get into Germany and failed. I like it. It doesn't bother me even the way they did France, because they tried one strategy, it didn't work, they took it back, and they don't do a deep, they test first. In other words, they're not saying, oh, let's take 50% of free cash flow and do capital allocation for our crazy idea. They run micro tests. If they fail on them, it's immaterial. It's never enough to suffer a major loss. So because they're dependent on, like, you kind of hear what I'm saying, they don't market directly to customers. It's not like they're spending a ton of money on Facebook. They're trying to get those tradespeople in that relationships. And because that takes time to build that relationship, and because Germans already had local manufacturers, I think it was a tougher go. The next thing to mention is buying groups, because you did mention it. That could be a major problem in terms of when you study the competitive landscape, there's a bunch of independents. If those independents consolidate and go into bulk purchasing, they could get some efficiencies. They obviously use their size for economies of scale. The other thing to mention here, and it's not a light one, is IKEA. So IKEA does flat pack kitchens. Flat pack meaning it comes already flat in a box. Somebody needs to assemble it. That's not considered high end in the kitchen world. That's considered lower end. The other game that's played is the grade of particle board. So you could have cheap particle board or expensive particle board, and that does result in differences. IKEA is not as customizable as what Howden's can do. But IKEA, if you look for the Nick Sleep model, what's the cheapest one to pass on savings to customers? It's going to be an IKEA type model that wins that.
Yeah, I don't know. I'm not too worried about IKEA. We have them here as well. Yeah. And I've saw their stuff. I have to agree. It looks very low end. There's a lot of issues with like a lack of customization. And I think, versus Howden's, I think they stick behind, at least I think for the stuff they make, right? The cabinets and stuff, they have, guarantee. Whereas Little is, it's okay now, but I don't know, in 5 years' time, it might not all fit as well together or have all these extra features which you can get from a specialist. 100%. Probably like Howden's. And when I ordered the kitchen for my home, we went to a place, they designed it, they came and took measurements, blah, blah, blah. But then they had to order it from Italy. And so the pieces had to come from Italy, and then they had to put it all together. But, I've been in the house for 18 years.
Right.
And it's still great. Whereas, and it's, like I said, it's not a high end, but it's not Little.
Let me $10,000 is what you heard. Sorry, 10,000 pounds is what you heard me say is their higher end. If you look at luxury, the Italian design, let me read it for you. Officine Polyform, and Mandi Casa. These are the luxury in UK kitchen manufacturers. And they're like quite blunt about it. It's like, yeah, you're going to buy a kitchen from us. It's 100,000. Like, that's the starting point, and we could go up from there. So it's fair to say, that's a different world. These companies, IKEA is flat pack. Howden's offers flat pack. So they do have a cheaper solutions. These luxury ones, we're in a different world in terms of design and taste and luxury and what they would offer and the customizable nature of it. There's one more key thing here, which is I'm always interested in what's sticky, what's the relationships like. Let's pretend for a moment that you have a family general contractor, you guys have been using for a long period of time. They're become a friend. You like and trust them. If they're a Howden's person, they're going to force you down that road, right? We'll pass on the trade pricing. They have the best designs. Value for money is there with them. I don't want to deal with, and this I personally had when we built a kitchen. We had like a character, older home. And they're like, we're not dealing with flat pack where I need to try to put the stuff together. And also your walls are not even. So we need to customize things to make it fit within very weird spaces. And they're like, the only way to do that is two manufacturers. And so already my universe went from so much competition, all these independents, some of the big players, down to you only have a choice of two. And in other words, live, as you're making your decisions, if you were dealing with a general contractor who's sticky with Howden's, it's kind of like once you're in that Apple network, they got you in that ecosystem, they're going to be pushing that. Their stickiness is shown in recurring revenues.
And what I really like about this company is how they've been going into nearby stuff. It's like you said, they're doing whatever the cabinets and now the tops and the paint and now it's bedroom and they even have this white label appliances, Lamora. Right.
Yeah.
Haven't had the best reviews. I was actually looking that up. Supposedly these are like made by Candy and then I got thinking, okay, how much of each of these are, what percentage is like the cabinets? What percentage is this and that? Have you found any information regarding this sort of breakdown rather than the geographical, like product wise?
Yeah, they do a brilliant job of here's our locations, here's maps, right? Here's where we went into Belgium, here's where we went into Ireland, here's where we are in France. Like wonderful. Breaking out detail by revenue, not their thing. They share very openly and transparency. Here's our global strategy, right? Like here's how we do group sales, here's how we're trade only, and here's why we're trade only. They say it's going to be 10 years to build up their physical network for any competitors, and it's almost undoable. Like it's not realistic because they have like Copart, right? Like they have a bunch of locations. They don't say, here's the kitchen cabinet line that makes us the most. Here's our percentage within that line.
Yeah.
I want to go way back for a moment in answering your question. The founder did everything. Once a day, he would call each and every one of the depots. This is obviously easier to do, and now would be done automatically via IT systems, and say, hey, what was your sales today? Because he wanted the general manager on the phone thinking about, what's my sales? And he also demanded to know, what are they selling? And in front of his office, he had the number one selling product, the closest to his office. In other words, here's the shaker style in a light blue. That was the most popular item ordered. And going on a scale down from there. Because they're warehousing and they're holding that stock, they don't want stuff that's going to be stale dated, that's ugly, that's not popular. So he wanted to send a psychological message. We care about KPIs, and this is what we should be putting in stock because this is what our demand is. Park that for a moment. To answer your question directly, this comes from me estimating things based on listening to earnings calls only. So Uncle Charlie Munger said, it's better in life to be roughly right than precisely wrong. So take this with a grain of salt and take this as ranges. Kitchens, base units, worktops, drawers, panels, 60 to 70%. Appliances, let's call it 10%. Joinery, 10% other. Lighting, they do like materials. So if you want to do tiling, they'll sell you the material to do the tiling. Let's call it 5%-ish. With a caveat, I'm not reading this from an annual audited financial statements. I'm reading this from my read of how they're doing. Yeah, so they're a kitchen company.
Okay.
This other stuff, yes. Right. Yeah. By the way, even within what I just described, international sales almost immaterial. Like,
yes,
they're UK.
It's nothing.
Yeah, exactly. 2%, 3% international. Yeah, there's opportunities. Be that as it may, let's call it 70% kitchens.
And it's kind of reassuring in a way that it's that the focus there is on kitchens. It'd be nice if we could tell like all these other things what's going on, just because, obviously like the bedroom could be growing at, two 200% right now, and we don't even
Did
know
you
it, right?
did you listen to their last earnings call? Because if you did, you just hit the nail on the head. They said bedrooms grew by 178%. So
I
it's down to
didn't.
200. Like your analytics, your variance analysis, or your budget is bang on 200%. But it's like,
Okay.
yeah, that compounded at 178%, but they just introduced it. That like
Yeah.
that doesn't really tell. By the way, if you go on their website and you look at the pictures of their bedrooms, it just makes sense. Like, what's the difference between a really nice wardrobe closet and a kitchen cabinet?
For
From their
sure.
standpoint, almost nothing. And they're leveraging their size, right? Like, in other words, the more they buy, the better. And by the way, there's something super interesting here too. Um, their cost of goods sold, what they manufacture as a percentage of cost of goods sold, went from 25% several years ago to like 38% now, meaning they're controlling more of their cost of goods sold. It wouldn't surprise me, you project this into the future, this vertical integration model that they have, this using their capital to buy worktops, to buy a paint company, whatever it is, it gives them more control. So they're using their size correctly.
So wait, that 25 to 35%, is that you're talking about gross profit?
No, sorry, that's cost of goods sold. The percentage of cost of goods sold that they're buying from others. Oh, we're buying screws, we're buying metal, we're buying handles, whatever, from suppliers, versus they're manufacturing it themselves. Their percentage of manufacturing of their own cost of goods sold is going up. They used to buy
Okay.
from external, now they're internal, controlling it through vertical integration.
Okay, so 35% of their
I think
cost,
38.
38% is what they manufacture themselves, is what you're saying. Okay. Now, because I really just threw that number out there, that 200%.
Good job.
But when I did, flick through their investor presentation, which was published, just recently, and I thought this is brilliant because they're so big in kitchens. They could easily also, pick this business up as well, and it could grow a lot faster, and it could become material. And I'm thinking the market, of course, for bedrooms is a lot smaller. I think, isn't it like a tenth or something of that of kitchens? Or does that make sense? I think I was googling
It
market TAM of kitchens and TAM of like bedrooms, and
it's very, very weird. So you have kitchen. What's the total addressable market? Okay, what's the total addressable market for all flooring? What's the total addressable market for all joinery? You're going to make moldings, stairs. You're going to make custom wood skirting. What's the total addressable market for the appliances that they're in? And what's their total addressable market for international expansion opportunity? And like, I become very, very conservative. I
mm-hmm.
like that they're testing this. I like that they're trying to go into this. In other words, what I just described to you is such a range of total addressable market. We're talking, let's say it's a 4 billion market cap or whatever. This could be 30-40 billion dollars we're talking about as an opportunity out there. Is this an oligopoly where you have 3 or 4 major players only that's going to consolidate internationally? I don't think so. I think it'll happen in each country. It doesn't necessarily happen at an international scale, with exceptions if you're the IKEAs of the world.
Yeah, and when we're talking about growth, I was flicking through some stuff in the past, and I think they were talking about that their target for the UK was like 800 depots. If you were like, I think this is back in, looking at some stuff from 16, 17, something like that. And now they're talking about, I think, 1,000. So it seems, they themselves have got their own market wrong as to how big they can get in it, um, or the other thing is, they're pushing it too hard. I don't know. And I thought, I'd just ask you, see if you had any thought on that. Or I don't know if companies just make up numbers eventually, and then when they reach those numbers, they just make up larger numbers.
I get very, very frustrated with some companies that are very short-term focused. And it's like, almost by quarter. And like, I'm like, you're playing games to try to get your share. Like, price up,
Hmm.
right? Like, and just annoys. This company doesn't really talk like that. They changed their estimate from 800 to 1,000, but they've stuck with 1,000 for several years now, and they're at 867. So they're last year they added what 30, 40 locations, like, and there's also they do a revamp of older ones, so that needs to be factored in. Sometimes they move locations. By the way, I should mention this company has no real long-term debt, right? Like they have leases for their
Yep.
depots, but they don't have debt. Um,
Love it.
yeah, exactly. So, okay. What's the population in the United Kingdom? What's it projected to grow? If you go to their government website, it's like, hey, we project it's going to go by 5%. It's going to have 2 million new citizens by 2030. There's also, when you see the percentage of aging UK housing stock, this kind of makes sense in terms of it's a lot of older apartments or housing with a need for more efficient, modern, especially when they go to sell or if it's a younger family.
Renovations, which is another
Renovation.
thing. It's
Yeah.
like you have renovations and then you have new home sales. I think they have said somewhere that that I think they do a
It's
bigger
like
percentage
90% residential renovation. So
renovations.
you think about it, it's like, okay, general contractor, Mrs. Jones wants a new kitchen. That's what's going on. It is not new build, let's put in 1,000. Like, not that they couldn't supply it, they're just not the go-to for their trade model of local independent general contractors, carpenters. That's their customer. And it's not the big developers. They talk about occasionally that there'll be apartment houses and they want to do a big renovation because they have economies, they could do it, but it's smaller scale residential as their primary base.
And that's also relevant here for the bedrooms because I'm thinking the bedrooms is more likely to be in a new home rather than be in a renovation.
Yeah, I would expect though that when you, this is why you got to divide up the TAM so closely. It's like, I think that they're going to continue to be, here's the general contractor who they use for kitchens. Now they're calling because their bedroom needs to be updated. Oh, hey, we could build you a custom closet for that one wall. It's going to have paneling. It's going to match everything. Great. So they get the business rather than, a custom builder or an independent. But this is once again not every single new subdivision. This is much more of piecemeal, home by home.
And these guys, they've been, growing at an 8% CAGR for the last decade.
Yeah.
Has no one picked up on this? I don't really think I've seen a direct competitor. There's no one who's focusing on the contractors. Is that right?
I would agree with you. Magnet would be the closest. 10-year revenue CAGR, 7.8%. So yeah, let's round up to 8%. You're exactly right. 10-year median margin.
I calculated that. That one.
You did it right. Stamped forensic auditor. Gross profit margin, 62%. Like, they're smoking their competitors. EBITDA, 16% margin. Free cash flow, 10-year margin, 11%. Return on assets over the last 10 years, 20%. Return on equity, 37%. Like, there's a reason they ended up on my watch list because they're so transparent. Here's our strategy, reasonable capital allocation. They're either paying dividends, buying back shares, or they're investing in the bedrooms and buying companies and controlling their cost of goods sold and raw materials better, or opening new locations, all of which are reasonable approaches. It's just been a reasonable company that's done well. And they say it. Well, here's our strategy. It worked. If you want to compete, good luck to you. They have the size, the physical network effects. I like companies that have moats. This company has some moats. Yeah.
Yeah, I mean, Magnet, are they, you said they're the closest. Have you looked to see what differences they have?
Magnet only has 5 to 10% of the market, so it's way lower as a percentage. They're part of the Saint Gobain group, so they have technical expertise. They also have a deep vertical integration with the other stuff that's in their parent family. So because of that, they're good at sourcing materials, leveraging their size. They're not as big. Like, there was this other company, Ren. Ren had 15% in the market or so. They just announced, man, like, there's pressures, there's headwinds going against. So the entire demand for kitchens went down. There was Brexit. There was high inflation. There was the pound sterling and what occurred to the dollar and risk and volatility there. They just announced their last year, 2023, that they had to lay off 1,000 people. Their profits went from 76 million down to 35 million. They're like, oh, we have a new strategy. We're going to be trying.
Mhm.
Even with headwinds going against Howden's, and so revenue being stagnant, it's not like revenue's been growing at 8% of the last 2-3 years. It hasn't. It's been much more stagnant. Their percentage of the market, of the total addressable market that they got, grew, which is an indication that their model's better. Their economies of scales are better. Their tradesperson model is the correct model.
Yeah, Ren has stores, I think,
Correct.
right?
And so if you go to a Howden's Joinery depot, this is not a retail customer friendly environment. If you look at the physical layout, it's like, here's a tiny admin offices, here's vertical stacking, it's a warehouse. We want it super easy for the tradesperson to grab a cup of coffee, pull their van up, shake a hand, get your stuff and out. It's like, okay, this is interesting. They have a small showroom with 2 or 3 kitchens, 2 or 3 appliances. It is not a luxury experience, meaning they don't have, like, I don't know about you, I largely hate retail. Retail's very scary as an investor. You study the history of retail, fickle customers, high fixed cost, high rents, high overhead. This is a mini warehouse tradesperson model, meaning it's not going to be a luxury experience for the customer to walk in and touch and feel that kitchen. It's just okay. It's enough that you can see the cabinet.
I'll tell you a funny story.
Please.
When we were building our house and we were doing the kitchen, my wife and I would go in the car and we're like at this warehouse in the middle of nowhere.
Yep.
We park in this dirt field, whatever it was, and we walk in and my wife is just disgusted. She's just, where did you bring me? Blah blah blah. And I'm like, this is why it's cheaper.
Right.
So, but we went there. We actually got some pictures or whatever from there. But it was, I completely, I know where you're coming from, and it's
like by the way, it's a fascinating model because when you study this, like Ren, one second, I'll read off some more. B&Q, they have 10 to 15% of the market. Wix is related as well. They're similar. These are much more customer friendly. By the way, if you read reviews on Howden's, we're annoyed. Where the hell's your pricing? Where's your list? Listen, I'm a do-it-yourselfer. I want to save some money. Like, you're annoying, right? Like so you read reviews and it's not like this is amazing. You go to YouTube and you see some famous person who's like, here's my beautiful kitchen. But of course it's paid and sponsored by Howden. So that's what shows up there. Because I'm trying to get a feel for the market. And what really helped me is putting myself in a tradesperson's shoes. It's like the front door, the red carpet, not in terms of fanciness, but it's rolled out for them. Let's make your life as simpler and easier as possible. Let's give it to you for free. Let's have the stuff in stock. The office space is so tiny, right? Like, and you could see where their priorities are based on the vertical stacking of that big warehouse. We want it easier for the tradesperson. The general manager of a Howden's Depot location is paid a flat salary plus a bonus. The bonus is calculated based on profit of the store minus any shrinkage. And you could just see it. So it's decentralized. That local depot manager is expected to create their own network, treat the tradespeople amazingly, get recurring business. They could choose what to keep in stock. So what the local demand is. So whatever it is that frequently breaks in a kitchen, I guarantee that local depot manager wants it always in stock so the tradesperson could just pop in, get the part, go fix the damn thing. And personally, I love this decentralized model. You're incentivized in a reasonable way and you have control over your pricing, over the extent of the discount to the local tradesperson, what inventory you're keeping, pricing, you name it. That's on the local depot. Hiring and firing, it's not micro managed at the head office.
Just taking a step back, when Ingalls left, right, and the current CEO was taking over, do you have in your research, do you see that as like a continuation, or is this guy doing things differently in any way?
So Andrew Livingston was the CEO of Screwfix, and that he held that role for a long period of time. Screwfix is a direct-to-trade people business. And think like tools. He was going to provide
Perfect.
tools to. He developed relationships with all these tradespeople. He developed online channels. It worked. There was very strong organic growth under Livingston's performance as Screwfix's CEO. Now he's been the CEO for 7 years. All right. You listen to earnings call. Everything is reasonable. Mini tests, right? KPIs that make sense. All right. He's like, hey, I want to modernize this. Let's do click and pay. So now they have this app. If you're a tradesperson, here's your app. And by the way, to their credit, they talk like a SaaS person, right? Like, what's percentage of time spent on the website? What's percentage of time spent logged in? What products are they actually looking at? All of this is tracked in detail. How many new users are we generating? How long are they spent? All of this is like, even as mini tests to me are so logical, like way to bring in modernity, right? Like I'm happy with him in terms of capital allocation. He doesn't do short-term gains. He's very, very blunt. My more conservative estimates on payback periods. For them to open a location and dump $300,000-$400,000 in to build it out and then put in $200,000-$300,000 worth of inventory, even if they're wrong on some of these locations, it's so absorbable.
They're probably thinking it matures in a couple of years.
Yeah, they're now said it used to be, payback period 2 years, mature. I think that's lengthened now, especially internationally, to like 7 years to get to full maturity.
Yes, I think I saw that somewhere. But at the same time, they classify same-store sales as anything that's not been open the last 2 years.
Yes. So UK, same depot basis, 24 to 2023, went from 2.2 to 2.2. So down by 1.2%. UK depots opened in previous 2 years was 42 in 2024, 9 in 2023. International depots, 69.8 to 74.7, so up 7%. Yeah, that's revenue. Yeah.
Okay. So I was looking, they have this open in the previous 2 years. So they still kept with that. They haven't, changed that. I have also read somewhere about that expansion, what you said to, 4, 5, 6, 7 years, whatever. But so I took their revenue, same store basis, and divided it by the number of depots which they allocate to that.
Yep.
And I saw that for the UK, they made about 2.83 per store million, and that's declined to about 2.73. So it's like about a 3% decline.
Yep.
But then when I did that for international, it looked like it dropped from like 1.67 to 1.27. So there's like a 27% drop if I'm looking at the right numbers here.
I get it.
It's on page 30. It's like 31 of the annual report, Mr. Forensic Accountant.
Red tab. Let's go. Circle. Sophocles is a percentage of total revenues.
Oh yeah, it's nothing. You're right. No, I completely get it. Yeah, we should note this. I'm talking about 80 million out of the 2.3 billion. Okay, so this 24%.
So I love the deep dive, but like in 2015 they were 1.2 billion. I'll just skip every 2 years. So 2015, 1.2, 2017, 1.4, 2019, 1.6 billion sales, 2021, 2, 2023, 2.3, 2024, 2.3. So you could see fast growing revenues, and then you could see tapered off slow growth. And so in other words, are we in a company that's in the mature stage? They're looking for other opportunities, expanding the product line, continuing to make sure that they're providing kitchens that are actually in demand, as well as trying some international expansion. You could see the tentacles going out. So big picture, the fact that you had a decline, international, some established stores. Okay, how long? Is this year 3 and year 4 of the store when they said it takes 7 years? Was there some sort of decline in the local economy of whatever that? Because if you had 3 or 4 locations, that didn't do well.
That's true. That
could cause it. So I'm with you. But like on a global macro scale,
yeah,
we have a bigger risk on an analytical basis than that decline.
Yeah, I mean, for sure. I mean, I obviously have not spent as much time as you have, but I was just trying to sort of like figure out, okay, how do these guys grow if they've already got like, 869 locations, they're going to go to 1,000. Yeah, they're going to also do this bed thing, which
Yeah.
is like, smaller, but, they'll get in there. But then they got this international. We could get a catalyst here from the international. How has this
Yes.
done? So I'm trying to sort of figure out, and I think maybe you could tell us how you're thinking about this going forward. So, because we've established already, this is an interesting business.
Yeah.
We've good capital allocation, fantastic returns, good margins, decent business model, market leader. I mean, this like ticks like a ton of boxes that, not overcomplicated businesses. They're not trying to discovering the next AI. They're just doing things that
Yes.
everyone really needs on a daily basis. So fantastic. So, but always in the markets, it's not about yesterday, right? The market is always thinking about tomorrow.
Yeah.
So, how are you thinking about the future of the sales? I mean, do you think like it's how are you thinking about this going forward as in, growth wise, top line,
Yeah.
margins? Are you breaking this out like and trying to figure it out like product line, or are you just looking at, the total? Are you breaking out, making assumptions on France, on Ireland? Because Ireland we haven't talked about at all.
Yeah. As per their earnings call, it's working. They like the Irish market. Okay, I'll just start talking and we'll see where this goes.
Let's
Current
go.
market cap is 4 billion. Price earning ratio, as of I don't know this past week is around 16. Price sales 1.8. Enterprise value of our free cash flow 13.5. This is not bottom basement. This is not a distressed. There's a competitor called Kingfisher PE. I think I looked this up yesterday, is roughly 13.88. So how does this better at 16? But probably warrants being better. They have some moats here. So, okay, let's take normalized income, right? And let's try to forecast this out. You calculate a mid range of high fives being distressed if the shares were in the high fives right now. In other words, I have this as a watch list. It warrants being on a watch list, in my opinion. There's a compelling story here. I trust management, their history of capital allocation being reasonable, as you heard me talk about the mini test and the stickiness and blah, blah, blah. So first test is, does it even make it on my watch list? And most don't, because management does weird things, or even you check their compensation. Like, this compensation is so reasonable. Here's your flat salary, here's your bonus, and they're like, the KPIs are all make sense, right? Hey, what's your cash returns? What's your recurring revenue? Hey, are you growing market share? It's all like, yeah, there's nothing crazy. And it's not like they're paying themselves $25 million and getting a private jet and with options that, or a private equity type structure where we're like, yeah, 20% of the profit is going to go immediately to us. And it's like, what are you doing? It's reasonable. And they're not doing a bonus only on revenue, which, by the way, is a massive red flag. So, okay, the first test, they made it on the watch list. Second thing would be, yeah, but what's a more reasonable, what's a valuation that would get me very excited? And
Mm-hmm.
you hear the conservative nature of me come in, right? Like, it's like See's Candy have tried for 50 years to expand out of the Western United States, where they dominate. They're unbelievable. We go to California all the time. My wife and I like to go hiking and all that there. It's awesome. Every time we go, we've got to stop in at See's Candy. They understand reciprocity because they read Cialdini's Influence the Psychology of Persuasion. They give us the free, caramel candy. We immediately buy a $55 overpriced whatever, and everybody leaves happy. That's the model. We get it. You go to Chicago, you're not going to find that damn See's Candy. They didn't succeed there. Like, there's no local demand. So I'm listening. I go every year to the AGM, right? I'm listening to Charlie, my flipping hero, Charlie. Hey, why is it that international expansion? Why is it that even expansion and domination in the United States didn't work? And he's like, it's hard. So going back for a moment, free cash flow yield is approximately 7%. During the past 13 years, it had a range of 3 to 12%. If you study the volatility within stocks, even 52-year week lows and highs, there's opportunity.
Mm-hmm.
Um, In other words, right now, would I be buying at this? No, because I'm too conservative. Could you make an argument that, well, listen, between their custom paint and their countertops and their bedrooms and their app and international, you're getting a reasonable stock at today's valuation with an option to do amazing internationally and look at their success to compound? Yes. Is that in my model with 100% certainty? No, because I've studied enough to be conservative. In other words, this is a watch list to me at the current valuation, but you calculate an intrinsic value, you're going to get roughly where the stock is at right now.
You know what? I did calculate an intrinsic value.
What did you get?
So, okay, I'll tell you what I put in. I'll show you mine if you show me yours. I just took consensus for next 3 years, which is like top line is 3%, 6%. Well, I only had about 20 minutes to put the DCF together, so I didn't really give it too much. So I put in 3%, 6%, 6%, which is the consensus. Then I go 5, 5, 5, 5, 5, 4, 4, 3, 3. So I just have it declining that way. I kept operating margin roughly constant around 14%, about 14.2. Just use current number shares, kept tax about 24%. Then let me just kept CapEx around 5% here. Depreciation, amortization on property, plant, and equipment only about around 2%. And so what I do when I do my intrinsic value is I calculated X leases. So then I also then make an assumption for the interest on leases. I just took whatever it was in 24. I think it was about 3% and just put that forward.
Leases show as a debt, right?
Yeah. But I'm calculating the cash flow, not taking into, I'm not adding back the depreciation from leases. And then I'm also expensing the interest. So when I did all that and came to free cash flow, that goes up from around 120 up to about 200 and something in 10 years time. We use a 9% WACC for that and 3% perpetuity growth. I came out with a present value of around £7.05. I try to be reasonable. I put in forward growth of around 5% overall for the next decade versus the historical 8. So how are you thinking?
I take earnings, I average them, I normalize them. I'm obsessed with free cash flow. Where's it actually going? I use the past because we have nothing else to go by. Make conservative assumptions. I lowered growth. Their last 15 years, I don't think is going to reflect their next 15 years. Mm-hmm. You do this, and where I become very, very engaged is in the 600s range, with bottom basement being high fives. Let's call that a PE of high single digits. I become very, very happy. I see a lot of discounted cash flows that has 10 years and then it's done. I'm like, I don't see this company going away in 10 years. So in the horse racing parimutuel bet system, right? Is it a good horse? Is it a strong horse? Is the rider competent? But also, how long is the track? Like, how long is that period? Because of the physical network effects, I think that this company has a longer trajectory. In other words, I'm not saying terminal at 10 years. I'm saying it's going to continue out. The growth assumptions, though, is where I become very conservative. And that's where I end up. On a watch list, I wouldn't buy at current valuation. One more big thing here. It's kitchens. It's cyclical. Like it's it's so cyclical. And so let's wait for an economic downturn and heavy tailwinds, and the market becomes really unsatisfied and people become very fearful. Competent management, great history, great capital allocation, profitability. That's my model.
Okay. I put in if I put in 3% after the next 3 years of consensus, right?
Yep.
Then it comes out to 653.
Uh-huh.
So actually, I'll be honest. I'm just just of my what do you call it? My sort of back of the envelope, quick valuation without going into all the detail we pointed to, because normally I would have liked to sort of like come up with an estimate for, they're opening this number of stores, they're going to get this revenue from this store, blah blah
Yep.
blah blah blah, and build that out, make some assumptions for Europe, make some assumptions.
Hmm.
I would try to do that. But
Yeah.
of course, you're talking about like project that would take a week at least, so not doing
And
that, and at the end of the day, you might even come up to a similar number to what it is today. So
correct.
having said that, I have to agree with you that I think it's a great company to have on your watch list. And it's one of those where it seems to me if a recession comes and they get hit, and these guys without having any debt, and there's what is there on the what is this, about 344 million of cash. So on their balance sheet there's 344 million, and all they have is leases, which is about 680. So they cover more than half,
Yeah.
about half of their leases is covered by cash on hand.
And they buy
So
back
if
shares too. They have a history of
Yeah,
buying back shares, shareholder friendly in that regard. Uh, I should, sorry, as I'm thinking for a moment here, one important thing to note. If you're to say to me, go back 20 years, Costco versus Howden's, Costco has negative working capital. And why am I saying that? I have to pay to even walk into Costco. So they take membership fees, and now they have working capital that's free. Great. Then they have unbelievable relationships with their suppliers. They're obviously huge volume, negotiate that, and then they don't pay. Customer comes in, they have very quick inventory turnover. Customer comes in and pays. Now they have not just the membership, but the inventory is turning. Now they have free cash. This company gives their tradespeople it for free for 60 days. They have to have the inventory, and it has to be well stocked at all times. So this is not a negative working capital situation. And further, in a very bad cyclical environment, their inventory is not going to move, and they prepaid for that or built it themselves. Their customers are not going to pay, and good luck on those receivables. So that percentage would change significantly as the tradespeople have to make an option of putting food on their table or paying their bill to Howden's. And does it take a genius to figure out your allowance for doubtful accounts is going to go up? Um, and so, like, part of this modeling of me being so conservative with my valuation is I'm comparing this to other opportunities. So how sure am I of another company that I completely understand that's doing a consolidation management, like a roll up, and management is very confident, they've had a long history of doing it. I'm far more certain on that bet than I am on this long-term international optionality, if that makes sense, which is why you're getting a very conservative valuation from me.
yep, yep. Well, so because like I said in the beginning, you were going to present this in clusters.
Yeah.
What
Yeah.
angle were you coming? So you don't own it. Were
Yeah.
you presenting it as an interesting company?
Yes. 100%. I love having a good watch list. To get a company on my watch list is so flippin' hard. I just see dumb things,
Mm-hmm.
or I don't understand it and it's too hard, which is a lot too. Some SaaS company, what's their moat? I'm out. Like, I don't, like, I'm not that smart. Lots of like venture capital type plays. I'm out. Management making very weird capital allocation decisions. Management not being transparent. Management being short-term focused. Non-aligned compensation models. Like, on and on I could go with red flags. It's so hard to get just a bunch of like interesting, compelling story. I can't think. You hear me talk a lot about other companies, but this is a unique company. Created uniquely. It's not really like its competition. It's doing its own thing and it's working. And the proof is in its financial statements for multiple decades. So it's like, because that's so hard to come across, I feel like I'm adding value, bringing it forward as an idea.
Yep.
Um,
I'll tell you, what I admire what you've just said is that you have the patience of, of putting it on your watch list and waiting for the right time, and
Are you a poker guy?
yeah,
Yeah.
I
Yeah.
used to play quite a bit.
So I wouldn't say I played quite a bit, but I played like with friends and whatever. And I discovered I have way more patience than people around the table. Like they just can't sit there. And my game, like I like it. I'm happy, full. Wait.
Yep.
Sophocles, if you were sophisticated, if you're Daniel Negreanu and you're playing against me, it's almost a lock you're going to take my money because I'll be too conservative and you'll just push me around. Right. Like that's
Yep.
just the way it's going to go. So I don't want to play poker with that's part of my game. The other part of my game is psychological alignment with my investing. If this company becomes cheap enough, would I buy? Yeah. And then could I sleep at night? Yeah.
I love
So
it. I
I
love
believe
it.
in leveraging your personality should be aligned with your stock portfolio. Comfortable. I bought at the right amount. I didn't make mistakes in terms of, I think, in terms of opportunity cost. If I have X, why can't I just go buy Berkshire? That's always an opportunity cost for me. It's almost a default, right? Like, how is this company better than Berkshire? And so it's an interesting, fun game to play. And like, I have friends that are highly aggressive VC people. They should not be looking here. It's not the right stock for them.
But the thing is, it's like, and this is one thing that I do is I also have, I look at what does my portfolio look like versus wider indices,
Mm-hmm.
right? How is my portfolio have lower debt? Does it have better returns? Does it have better margins? What's the growth look like? Like you, I'd say, okay, well, if I'm gonna, put it in there, it has to qualify. And this sort of thinking about this actually saved me this 2025 because I've been selling a lot of my positions, and I was out of I've sold more than 40% of my
Mm.
portfolio before this whole drop came, just because I was doing a lot of reverse DCFs. And I was figuring out, well, I like this company, but it's going to have double digit growth in order for the valuation to make sense here. And there's not a lot of people who think like that. People don't have the patience, and they jump into things. Whereas, and I think this is the pure rule number one, where it's not about not losing money. Of course, we're going to lose money, but it's how you position yourself to reduce the probability of losing money.
By the way, would say the average individual there should stop thinking that they're brilliant and buy the index and turn their brain off, and they'll do far better than what they're about to
Yeah.
lose. Statistically, I'm right. Same with the hedge funds, and I'm right. Park that for a moment. If you do that and you're never in the market, you're not engaged with this part of the brain, you're not having these conversations. So I would look at this more holistically than pure returns. However, on a rational pure return basis, I'm with you. And when you look at the history of my own capital allocation and what it's changed over time, it's like, how many stocks did I buy that didn't do what I expect them to do? Which is why you get a ridiculously conservative valuation from me. Otherwise, I'm out. Yeah.
Okay, so a few hours ago, I actually went into my Cypress Valley investor group, and I said, "Hey, I'm going to be interviewing someone on Howden Joinery. If anyone has any questions, just shoot them over." And I actually
Cool.
did get a couple questions, so I'll shoot them to you, and you can feel free. So, main question: they say they have around 20% share of kitchens market, so lots of room to grow, but they only sell to trade contractors. They must have, say, 75% of this market. So, how do they tap the rest of the kitchen market if they only sell via the contractors?
If you're direct to consumer, if you're a consumer focus, this is not where this company is going to be competing. Remove that from their addressable market. I see no indication in years of listening to earnings calls and years of reading annual reports that they're changing their model. So direct consumer is a different need. The showroom is different, design is different, pricing is different. It's not the model they have. Remove that. They're never going to have that as an addressable market.
And another question here: what is the return on capital employed hurdle for new depots. How do they reach these levels? How many years? Do London depots have higher or lower returns than company average? So I guess it's what's the hurdle for new depots, and is London higher or lower than the company average?
Without a doubt, you have depots that have 3 million plus revenue in UK. You do not have that international when you do an average per. And keep in mind, there's timing differences, right? So you're taking the total revenue, dividing it by the number of depots, right? Like, well, when did they build that depot within the year? But I'm more macro when I look at this. In other words, more globally, you take a look at it, and it's like triple or quadruple revenues at long established UK versus international. Their payback period used to be 2 to 3 years, and that was their threshold, right? And so it used to be, and they say this, 200,000 roughly to do a build out. So I up that to 400,000 now. And then inventory, let's call that another 300,000. So to get that payback period used to be 2 years. Now they're talking international 5 to 7 years to get that. That would be their test. Because they need an entrenched market and the relationship with the trades, it's not going to be what it used to be in UK of 2 years.
Okay. Yeah, I think we've touched a lot of stuff. I've had a lot of fun.
Let's do it again.
We got to do this. We got to do this again. Well, you know what? S&P I see is now like down around 1%. So
Yeah.
if this keeps going, I think we're both going to be long Howden.
Let me know when you're buying, if it meets yours, if you're actually go in. And then we have a rule. If you're in and I'm in, if you're selling ever in the future, you text me, same me to you. And it's like, what changed? What are you seeing? Did your thesis change? Did management change? Did the opportunities change? Did the valuation change? Why? Right? It needs to be a rule.
I love it. I love it, Jeff. And this is what I've told a lot of people is like find other investor friends and talk about your investments, and you'll just become better. They'll tell you some stuff that you might not see, or and vice versa. So
I'm 100% with you.
So Jeff, thank you so much for doing this. Other than that, unless you have any final remarks,
My final remarks is off. Please keep on being you.
Thank you, Jeff. The podcast episodes should not be copied, distributed, published, or reproduced in whole or in part without the prior written consent of the host. These recordings are for informational purposes only. This recording does not address all risks. The podcast is not intended to be relied upon as a forecast, research, or investment advice, and are not a recommendation, offer, or solicitation to buy or sell any securities or to adopt any investment strategy. The views and opinions of any podcast participants are subject to change and are not necessarily those of any companies affiliated or associated with the participants. The participants cannot guarantee the accuracy of the information in this podcast and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. There is no guarantee that any forward-looking information will come to pass. Reliance upon information on this podcast is at the sole discretion of the reader and/or listener. Past performance is not indicative of current or future results. This podcast is being made available for educational purposes only and should not be used for any other purpose.